Home equity lines of credit are referred to as Helocs. They are commonly secured against the property in second position behind a first mortgage, but they can be in a first position if there is no first mortgage in place. Helocs are monthly adjustable rate mortgages tied to the prime rate index, which can adjust monthly with the Fed funds rate. There are two factors that determine the interest rate: the index, the prime rate, and the fixed margin. The margin is usually determined by the LTV and CLTV, credit score, line amount, and property use. Owner-occupied properties are most common, but some investors will allow second home use. Due to high risk for the lender, investment property financing is not an option. Let's look at an example.
We'll assume that the prime rate is at 4% plus the fixed rate margin of 2.75% gives you a monthly rate of 6.75%. The life cap on a home equity line of credit is usually 18%, which is the max interest rate one could see.
The line of credit works similar to a revolving credit card. You only pay interest on the portion of the credit used, not the full available credit line. You can use the line and pay it back and use it again for a 10-year draw period. During the draw period, the minimum payment due is interest only, but after the draw period has ended, the owing balance is amortized over the remaining term of the loan, which is typically 15 to 20 years. Loan qualification is very similar to a first mortgage, and the higher the credit score, the lower the margin will be.
This history chart will give you a good idea of how the prime rate index has performed over the last 62 years. You can see it's been at an all-time low for 8 years, but what goes down must go up eventually.
Helocs are used for many purposes, but not all are a wise use of equity. A wise use would be for a remodel or an addition. An unwise use would be for debt consolidation, buying a new boat or trailer, buying new furniture, paying college tuitions, or paying for a vacation. Review the True Capacity video on how to stay out of debt and save for future needs. A cash-out refinance consolidating the first and the second mortgage into one loan could be a wise option in some circumstances. It would make sense if the fixed rate is 1% or more lower than the current fixed rate on the first mortgage, and the balance has been reduced for less than 5 years. Helocs don't typically have closing costs, but if the line is closed within a 3-year period, there could be an early closure fee of $300 to $500. Paying off the balance and leaving the account open is advised for the first 3 years. And that covers home equity lines of credit.
Thank you for watching, and here's how you can help us. First, share us with your network on Facebook, Instagram, Twitter, and YouTube. Secondly, tell your family, friends, and coworkers about us. And lastly, we are publicly funded and need your help keeping our videos free by clicking on the Support tab today. Don't miss the tips and timing video, found only on our website, for all the ways that you can save hundreds of dollars when buying a home.